Swayam Prabha. Digital India. Educated India.
Good morning. Today's session, that is number 34, we will be discussing on international financial stability, how the financial sector over the year developed, how the different sectors of the economy interact each other and create financial sector instability, what the theories are there on financial sector instability, what is the process of getting financial sector stability we will be discussing in this session. Let us start with what is financial stability. If you see, it is very difficult to define what is financial stability. Generally, different researchers on this area mention that when a financial sector will be stable, when there is no instability. So, removal of instability is the first to achieve financial sector stability. The question arises here, which are the factors or sources that create instability in financial sector. If you would see, world financial system over the period has developed tremendously. Here the development in the form of growth, development in the form of innovation and development in the form of what is called deepening and widening of financial sector. Which are the changes that contribute in the development of the Indian development of the financial sector or the growth and innovation in the financial sector. If you analyze the history of development last 30 years, we can find that development of new product, market and technological innovation has impacted the financial sector both positively and negatively. There had been significant reduction of trade barriers and financial control last 30 years. Developed and developing country have liberalized the financial market. Many emerging market economies have developed last 30 years and this development took place because of financial decontrol or what is called financial sector liberalization and reduction of trade barrier. There has been cross border financial what is called payment system. The cross border financial and payment system increased significantly during the recent years. There has been international diversification of asset portfolio. There has been development of financial instrument in the form of derivative product, securitization market, which has no doubt helped in hedging financial risks. At the same time, it has created many different kind of risks in the financial system. There has been greater risk sharing internationally through a broad area of financial instrument. The increasing share of cross border holding of assets, increasing diversification of international portfolio and there has been significant development of new financial market, new financial instrument and different kind of financial sectors. As a result of this, the geographical domain of financial intermediation has widened and it has been more globalized at present than it was before. Because of this reason, there has been increase of financial instability and spillovers of financial risks from one country to another country. The financial instability created or generated in one segments of financial market, in one segments of the country or one region of the international financial setup has been diversifying, has been globalized because of international integration of financial markets. And if you see if you see the impact of this financial globalization, we can identify that the impact in the interest rate determination process, the impact in the creation of volatility of financial assets, the impact in the export reduction of export competitiveness, in the impact maybe in the overheating of local economy, and also increased financial fragility. So, the impact can be seen, the autonomous character of interest rate determination is no more. The interest rate definitely determined by the domestic financial demands and supply. However, it is not so, it is not at present. The reason being cited as international character of the interest rate determination. It is not only the domestic parameters or domestic variables that determine the domestic interest rate, but also there has been international dimension of this interest rate determination process. The local volatility or volatility of local market financial instrument has become globalized at present. The volatility of domestic currency and reduction of export competitiveness is one of the major impact or of financial globalization. There has been overheating of the economy in the form of excessive expansion of aggregate demands. When the rupee or the domestic currency increase their what is called circulation because of the FI inflow, because of foreign direct inflow, there has been overheating of the economy. There has been overheating, we will find in the rising of inflation, circulation of domestic currency, and this has impacted many emerging market economy because of globalization. If you see the financial volatility, there is recent years we have witnessed the financial volatility very high, not only in the realty sector, but also in financial sector also. The financial sector, if you see the financial volatility in the form of asset volatility, in the form of stock market, equity market volatility, in the form of exchange rate volatility, in the form of also domestic debt market volatility. So, the financial globalization has contributed more in increasing the volatility of domestic financial sector and rather helping the economy in developing itself. So, we have to arrest the financial sector volatility because there is no other way than accepting the globalization. The financial globalization, we have to be a part of this globalization process, at the same time we have to what is called safeguard our domestic economy from international volatility pressure or forces. If you see the financial stability, how we can define it, because there are many parameters which impact or maybe influence because of the financial stability. So, financial stability is a broad concept, we cannot define by having one parameter or one line of definition. So, financial stability is a broad concept which encompasses real and monetary sector parameter and focuses on overall stability of the economic system. So, in economic system we have real sector and at the same time we have monetary sector. The real sector is the inflation, interest rate that define the real sector. The real sector is the growth of the economy and the monetary sector is money supply, the financial sector stability, particularly the asset price stability, the exchange rate side, the what is called the increase of broad money supply, all these things comes in the monetary sector. So, financial stability only can be possible when there is stability of the real sector, that is control of inflation, less volatility of interest rate, and at the same time stability of the financial sector or monetary sector together. So, financial stability is generally understood as absence of any kind of financial crisis in any segments of the financial market, including high volatility in financial prices like interest rate, exchange rate, equity prices. With the integration of various segments of financial markets and emergence of new financial institution and instrument, the financial instability has been increasing tremendously during the recent years. So, the causes of integration may be causes of the financial instability, nothing about integration of segments, different segments of financial market, emergence of new financial instruments, new financial markets, new financial institution, and also instability of the real sector, which may also contribute to the financial sector instability. So, what way we can define the financial sector instability? The financial sector instability or financial sector stability is that there should not be financial sector instability, and stable monetary sector, stable real sector can only define or only can provide financial sector stability. So, financial sector stability is the overall stability of the economy, where monetary sector and real sector coexist and interact each other and create what is called a stable market economy. So, if you see what are the drivers of financial instability? So, drivers of financial instability are the rapid growth, complexity of financial market instrument, inflexibility of what is called safety net or buffers program, cognitive bias, the psychology of the investors, the behaviors of the investors. Then also we can say that adverse leadership, the real economic shock, the effective control actions, all these things can drive the what is called the financial instability. We will be discussing each of these segments or each of the contributor to the financial instability. Let us first discuss rapid growth. If you see last 30 years, there has been significant growth in the world economy. The growth redefined the shape of the world economy. Last 30 years, many emerging market economy developed themselves, new market economy created. The developing world, particularly the China, India, the Brazil, Mexico, Philippines, they developed themselves and created what is called emerging market economic phenomenon. This the financial crisis generally follow a rapid economic growth and expansion with aggressive financing, innovation and over optimism, because the contributor in the financial rapid growth is the aggressive market economy. The aggressive market economy created through rapid innovation and over optimism, and that lead to financial sector instability. The complexity of financial market, particularly expanding size, scope of the economy, the more complexity because of the depositors and hard for the depositors and investors to understand what is actually going on in real financial sector. The complexity of financial innovated product, the complexity of market economy, the complexity of rules regulation, the complexity of what is called the financial institution way of working, that actually redefine what is called the depositors and investors to understand the financial market. So, when depositors, the investor and the borrowers, they could not understand the financial sector, they take maximum risks in the financial market, and because of this that financial market become unstable, and the instability of financial sector or one segment of the financial market spread over to other sector of the economy, an economy as a overall become unstable over the period. If you see inflexibility, inflexibility another drivers of the financial instability. What is inflexibility? It is nothing but the absence of sufficient safety or buffer or cushion against shock. Inflexibility means whenever there is a financial crisis, whenever there is one segment of the financial market is highly volatile, what are the safety measures we have introduced to safeguard the financial system? The safety nets are absent in financial market nowadays, and because of this safety net program, the depositors insurance facility, the protection to small investor, all these things are not there in the many part of the world economy, many countries at present, and because of inflexibility created more financial instability in the economy. The cognitive bias another drivers of the financial sector instability. If you see what is cognitive bias, the cognitive bias is the behavior of the investor, the behavior of the trader. So, if you the traders behavior, the traders investor behavior lead to financial sector instability also. Psychologists and behavioral economists such as Nobel laureate economy Daniel Kahneman has documented cognitive bias in markets such as over optimism, over pessimism, failure to ignore sunk costs etc., can lead to what is called irrational behavior, and such as bank runs, cash hoarding, excessive risk taking investment, all these things contribute to financial sector instability. When market is up, over optimism, everybody, all investors take more and more position in the market. This is called hoarding behavior. The hoard behavior created in the market may lead to financial sector instability, and the behavioral economists have considered the cognitive bias as in the form of over optimism, in the form of pessimism, and this has created many financial sector instability in the over last 30 years. If you see other drivers is the adverse leadership. What is adverse leadership? Leader to think and advently or inadvertently in advance of crisis that elevate risks, because in the financial sector leaders they should predict the financial sector crisis, or they should try to protect the financial investors. And adverse leadership, because when the leader of the financial sector could not understand the behavior of the financial market, that create more risks in the financial sector. The real economic shock another drivers of financial sector instability. There will be some event that leads to what is called depositors, investor become more credit inertia, trigger the panic. Economic real shock, economy real sector of the economy, that is the growth of the industrial product, the growth of the economy, the growth rate of GDP, may inflation, interest rate may sometime what is called give some signal to the financial sector instability, and we as a investor, as a depositor, as a players in the financial sector could not understand this, and this lead to panic behavior. When IIP index of industrial production decline, because every month IIP may come, the figure may ups and downs will take place, and when there is up, the investor in the financial sector take more risks in the financial investment. When there is down, they become panic, and this lead to panic and optimism together lead to crisis in the financial market. The real economic sector or real sector shock may created some kind of financial instability, and nowadays when the real sector and the monetary sector are interactive each other, and the real sector phenomenon has been generating financial crisis in recent years. Effectiveness of collective action. There are another drivers of financial sector instability. The depth and duration of financial crisis is determined by the effectiveness of collective action. When there is a financial sector crisis, collectively you have to take measures and the depth and the duration of this financial crisis is determined by the effective collective action. When collective actions are taken by the leader, by the regulator of the financial sector, they generally see the duration of financial crisis. The duration of financial crisis can be reduced when collectively we fight with the financial sector instability. Such action include organization of pools of liquidity, the rescue of institution, and generally effective efforts to restore confidence. The financial sector instability generally reduce the confidence, business confidence in the economy, and business confidence can only be possible to increase when collective actions are taken. And collective actions in the form of reorganization of financial market, the collective action may be in the form of pumping of liquidity, collective action may be in the form of buying of what is called rotten assets, collective action may be in the form of reorganization of financial institutions and market by what is called pump priming program of government, may be confidence in building measures. All these things possibilities are there when collectively you can fight with financial sector instability. The effectiveness of collective action may reduce the financial sector instability or duration of the financial sector instability. So, this is also one of the drivers of financial instability. When there is collective actions are not there, financial instability spread much many years. If you see other drivers are there like drivers of what is called the monetary sector real sector integration side. The monetary sector real sectors are not integrated. So, the pulse and prime programs of government like fiscal policy, the monetary policy may not give some kind of signal to financial sector. That would be cooperation between the monetary sector and the real sector to reduce the burden of the financial sector instability, and once the financial sector unstable or financial crisis is there, how to overcome it. That overcome from the financial sector instability is possible only there should be collective action both from the monetary side and also from the real sector side. Then question is here, there are many theories of financial instability. The question, what are the theory over the period developed to define the financial sector instability, to create what is called some kind of programs or some kind of collective action to fight with financial sector instability. The theories are primarily broadly defined in the form of what is called monetary approach, non-monetary approach, and also asymmetric information approach. We will be discussing each of the three approaches of financial stability theories. So, monetary approach, here monetary sector regulator, particularly the central bank play leading role in reducing the financial sector instability, and because they play the prime roles in developing financial sector and developing the money liquidity system in the economy, the payment system in the economy. So, many theories developed through the monetary approach side. So, monetary approach enunciated by Friedman and Squads, that it traces the financial stability to banking stability. They consider the financial sector stability as a banking sector stability. It identifies financial crisis with banking panic and either cause or aggravate monetary contraction. When there is a banking sector crisis, it leads to financial sector crisis, because banks are the backbone of payment system. Banks are the backbone of providing liquidity in the system. When banks are run, banking panics are there, it creates financial sector instability, and the monetary theories, monetary theory particularly developed by Friedman and Squads, they define the financial sector instability in the form of banking sector instability, because banking sector is play the major role in monetary sector development, in that transmission of monetary sector signals to financial sector. They act as the intermediation between real sector and monetary sector. When banks are in panic, it creates financial sector instability. The non-monetary theories, non-monetary approach is nothing but the financial fragility, debt deflation approach. The non-monetary approach, also known as financial fragility, debt and deflation approach. Here the theory regards crisis and contraction in economic activity as inevitable consequences of excess economic boom. Modern proponents of these views are in Minsky, Kindlewager, Koopman, Friedman and King, who extended the argument made by Fisher. Actually, the Fisher first developed the what is called non-monetary approach or the fragility debt deflation approach towards financial sector instability, and this theory has been further developed by Minsky, Kindlewager, Koopman, Friedman and King. They consider the economic activity in the form of contraction, in the form of expansion that contribute to financial sector instability, because the banking sector act as the intermediation between the real sector and monetary sector. The real sector expansion, real sector contraction lead to rising of debt, and when the debt in the economy increases, it creates financial sector panic and financial sector instability. So, the expansion or contraction of economic activity that actually contribute to financial sector instability, as per the non-monetary approach, consider financial sector instability as a financial sector fragility, debt and inflation side which contribute to financial sector instability. So, monetary approach consider banking sector fragility that contributes to financial sector instability, and non-monetary approach consider real sector instability that actually create financial sector instability. So, if there is other theories are there are asymmetric information theory also there. Asymmetric information, because the financial sector, the major players, the main two different players in the financial sectors are the buyers and sellers, or you can call investors and borrowers. The buyers and seller, when there is asymmetric information are there between buyers and seller, they are created that lead to financial sector instability. So, asymmetric information approach states that lenders are not adequately informed about the background of borrowers and the viability of the borrowers lead to this, which lead to potential return of alternative project, thereby rendering a source of financial instability. So, in economy there are borrowers are there, the lenders are there. So, lender provide money and borrower take the money for development of the different kind of project and growth of the real sector. When the lender do not know about the quality of the borrowers, the viability of the borrowers, and there is asymmetric informations are lack between the borrowers and lenders, that is lenders are not sufficiently provide different kind of information about the borrower. When the borrowers become default, it leads to financial sector instability. So, here the economy is defined in the form of lenders and borrowers, and lack of information about the borrowers with the lender leads to financial sector instability. At the same time also, when the lender provides borrower for financing different kind of investment project, the investment lack of information about the success and failure of the information about the investment project leads to financial sector in crisis. So, when lenders do not have sufficient information about the project, viability of the project, the viability of the borrower, this lead to financial sector instability. There are also asset liability mismatch approach. When asset liability mismatch approach provides particularly it leads to banking sector crisis, and banking sector crisis leads to financial sector crisis. When banks created assets through the liability or the depositors money, and the assets are not giving income to the borrower, to the banks, asset become non-performing asset, it leads to financial banking crisis, which further lead to financial sector crisis. Similarly, recent approach like incentive structure approach. What is incentive structure approach? Rajan 2005, the Raghuram Rajan recently 2005 in his research paper argued that changes in the financial sector have altered the managerial incentive, which in turn alter the nature of risks undertaken by the financial system with some potential for distortion, because the financial sector are ruled or the managed by the what is managers. When manager incentive, the salary, perks, incentive of the manager depends upon the returns what they are getting from the financial market. The potential it create, the manager take more risks, because when they take more risks there will be more return, and when there is more return they will get more managerial incentive, and this lead to distortion in financial system, and the distortion lead to creation of potential risks, and this lead to further financial crisis. So, what Raghuram Rajan argue? He argued that the managerial incentive leads to more risks in the financial system, and when the financial system is on the top of a higher risk, potential risks, there will be financial crisis. Is there any other approach? This free approach, the 4 approach define what is called the financial sector instability, or what is called different theories of financial sector. The financial sector theory argued that it is a monetary activity or the banking crisis that lead to financial sector instability. The non-monetary approach mentioned that is over optimism, expansion, contraction of the real sector that lead to financial sector crisis. Then asymmetric information approach mentioned us that it is a lack of information with the lender about the borrower, about the investment project that lead to financial sector crisis. The asset liability mismatch, or when the assets, the banking assets do not create income and become non-performing, it lead to financial sector crisis. And Raghuram Rajan recently argued that it is a managerial incentive lead to financial sector crisis, because manager take more risks for more incentive, and when the economy and the financial system on the top of a financial more risks, it create financial crisis. So, these are the theories of financial instability or financial crisis. Let us define actually in Indian financial system what is the level of stability, which are the factor or indicator that define stability in Indian context, and how this factor develop over the years, how this factor or the variable have migrated to different phases of economic activity, and how we can define what is the level of financial stability in India at present. Let us define what is called financial sector stability indicators. So, what we understand from the theories of financial crisis or financial instability, that from there you can derive the variables or indicators of financial stability or instability in general. So, high volatility of asset prices, rising interest rate, liquidity crisis, high default migration of corporate rating, rising non-performing assets of the bank, excessive volatility of exchange rate, rising current account deficit of the governments, then rising inflation. All these things contribute or the leading indicators of financial sector stability or instability. Let us discuss each of these indicators in the Indian context. So, if you see, first thing you will decide about the volatility of the exchange rate. Here I have given you the graph what is called 2008, when the financial sector international or the world financial sector crisis started in 2008 till now it is continuing also till 2012-13 is continuing. What is the fluctuation of Indian rupee against the US dollar, the volatility of the spot rate. I have taken the monthly volatility of the spot rate from 2008 to 2012. If you see January month 2008, it was exchange at something around 38-39 rupees. In 2012 January, it is now something around 48-49 rupees. So, this graph 2012 graph and 2010 8 graph, you see how the rupee has become highly fluctuate and depreciated over the year because of the what is called instability of the world economy, which actually started from 2008 onwards. So, the graph indicate the rupee has been depreciating over the year because of the financial sector instability, and also at the same time rupee is fluctuating or volatile over the periods. This indicate the volatile and the depreciation together indicate the Indian economy not so much stable as compared to 2008 and 2012. Similarly, next indicator, the volatility indicator, I have taken rupee in the exchange rate volatility. You see the volatility in 2008 that is this graph indicates the volatility 2008 is quite high, because that time the actually world economy was unstable and the instability in the world economy started during 2008. This volatility over the period has decreased. In 2010-12 also rupee is volatile, but not so much as compared to 2009 and 10. However, rupee has been depreciating over the year, that also there over the period. The volatility and depreciation indicator indicate Indian economy is unstable from 2008 onwards. Next indicator is the interest rate. For interest rate, I have taken the Government of India 10 years yield, and I have taken the data from 2009-10 to 2011-12. If you see the 2009-10 data, the yield was not so much, interest rate was not so high. With the progress of the financial crisis 2010-11, interest rate increased, yield has increased, interest rate also rising over the year. At the same time 2011-12 interest rate further increase, the graph green color graph is increasing, the interest rate further, yield has further increased. So, this indicates that from 2009-10 onwards the interest rate has been increasing, and it is from 6.42 in something in 2009-10 April, it is increased to something around 8.42, nearly 200 basis point, increase. Why the regulator increase the interest rate? Primarily to control inflation, primarily to reduce the money supply in the economy, so as to arrest the instability in the financial sector. So, another indicators, the indicators of liquidity. Here I have taken liquidity of the economy, that is M1 I have taken. You see the liquidity was quite high during 2008-9, which reduced to negative liquidity. You see 2008-9 something in October, November, actually September onward the financial sector crisis started, 2008 September onwards, and In October, November 2008, the liquidity was negative in the economy was illiquid that time, there are more demands of liquidity was not there in the system, and this has revived little bit, and now at present liquidity also around 2 to 3% is there, still it is not so much as compared to earlier years. This also indicate liquidity in the system, lack of liquidity or the illiquid system also indicate what is called financial sector instability. The another indicator is the current account deficit. Current account deficit of government of India, this is nothing but the export might have reduced, import might have increased, rupee might have depreciated further, and at the same time FII flow may not be there, and during this period which lead to financial sector in crisis or current account deficit. Rising current account deficit is another indicator of financial sector instability. So, if you see, I have taken the data of 2008-9 to 2011-12 quarterly data, and you see quarterly data of 2008-9, the third quarter was negative started from the second quarters onwards up to first quarter the economy 2008-9, that is the current account deficit was not so much, but deficit increased from the second quarters onwards, and it has been increasing over the year. And if you see government of India current account deficit something around more than something around $80 billion, something around $80 to $90 billion over the years. So, this indicate the deficit in the economy increasing or the current account deficit increasing, and this is another indicators of current financial sector instability or unstable. When current account deficit is increased, when the export is not picking up, when rupee become depreciating, and a net inflow in the form of FI become negative or reduce over the year, this lead to current account deficit, and all these indicator, that is a lack of FI flow, reduction of export competitiveness, depreciation of rupee, all these indicate there is an instability in the economy. So, another indicator is the banking sector indicator. When banking sector asset become NPA, that leads to banking crisis, and if you see 97 onwards, the gross NPA of the economy, it was quite high up to 2002, after 2002 it declined, and 2007-8 onwards, that is the crisis year, the 2007-8 from 7-8 onwards, the world economy become unstable or instability or world financial crisis started. That time onwards, the NPA has been increasing over the year, gross NPA of banking sector in India increasing. This also indicate Indian economy is unstable. Another indicator is the inflation. Rising inflation also another reason for the financial sector instability, and this is, if you see, since I have taken the data from 2008-9 to 2011-12, and this also indicate the how 2011-12, if you see 2008-9, if you see red color data, we have a negative, almost 0 or negative inflation, and however, it increased over the year. You see from the 8-9 it was inflation was declining, but 9-10 onward inflation has been increasing, and it is more or less more than 8% last 3-4 years. This also indicate the rising inflation also indicate financial sector instability. Why rising inflation will be there? Because regulator wanted to control money supply by increasing the interest rate, by reducing the money supply in the economy, and also there will be growth in the economy is not picking up. This will lead to the inflation in the economy. High inflation is an indicator of financial sector instability, and 2008-9 onwards inflation in Indian economy has been increasing. Another indicator is the asset price volatility, particularly the return volatility of National Stock Exchange. I have taken the return volatility of National Stock Exchange 4 year data 8-9 to 10, 11, 12, and that is monthly returns of NSE, National Stock Exchange monthly return, NSE Nifty 50 monthly return I have taken into account a month, and from 2008-9, 2011-12 data. If you see, the return is highly volatile. 2008-9 it was a decline negative market, almost down by 40%, return was down by 40%. 9-10 slightly increased, because some FI inflow was there in the economy, because which pick up domestic expansion, domestic market was there. So, domestic expansion was there, but 10-11 onwards domestic economy also shrink, growth rate decline and return again negative. About 11-12 again also it was not so much, and a negative return is there, monthly return is negative. So, asset price volatility is there, asset price return is also declining. This also indicate there is in instability, or in Indian economy is unstable in over the period 2008-9 onwards. Another is a realty sector indicators. Realty sector indicator I have taken National Housing Bank indicators of 5 different city in the economy. The National Housing Bank generally give quarterly realty index, that is demand and supply, the demand of the per square feet area, that NHB giving National Housing Bank provide, and this is the Hyderabad, Chennai, Kolkata, Mumbai, Bengaluru and Delhi, the 6 prime city of the India. What is the indicators of per square feet, the price of the per square feet. If you see the data, I have taken quarterly data, January to March, then April to June, July to September and October to December. The in a year 4 different periods, and if you Hyderabad relative price almost remains stable, there is no growth. There has been Chennai, the relative price little bit increased last 3 years. However, Delhi, Bangalore, Delhi all remain constant, because there is lack of demand, oversupply in the economy, lack of demand, realty sector index also remain unstable, and there is no increase in the relative sector prices. This also indicate there is no expansion in the Indian economy, Indian economy in a declining phase at present. Similarly, I have taken 2011-12 data, this is 2011 data, this is 2012 data, same thing reflect in both the year. So, what are the, we have discussed the Indian economy on the basis of various variables and indicators of financial sector on instability, and now question arise, what is the strength of Indian financial system. So, Indian financial system despite world economy at present in the crisis, Indian economy is growing around 5 to 6%. There may be some negative side of the indicators of the financial sector and in stability. However, there are some positive features, a strength of the Indian economy. The strength of the Indian economy I have identified through different kind of what is called different kind of financial sector segments or different kind of exposure limits. So, if you see the strength of the Indian economy is the own domestic expansion. So, despite Indian economic crisis, the world economic crisis, Indian economy is growing around 5 to 6%. The domestic growth potential, the consumer base of the Indian economy is the prime indicators of strength. However, there are other segments of the strength also there. So, if you see Indian economy at present, significant government ownership in banks is one of the strength of the Indian banking sectors. Despite deregulation of interest rate, deregulation of financial sector, government stake in the major banks of the major bank is significantly high. This is the strength of the Indian banking sector. So, Indian banks also provide what is called depository insurance. The depositors' money are insured. This is also one of the strength or indicator of the Indian banking sector. Compulsory investment in government bonds, despite the public sector bank and private sector bank need to invest in CRR, SLR, in government bonds, a significant part of their deposit, that is around 25% of the deposit they need to invest in government bond. That is also one reason a strength of the banking sector in India. There has been investment side on the part of the banking for commercial banks, the regulated investment in the equity market. Banks are not allowed to freely invest in equity market. So, equity volatility may not affect the banking sector prices, banking sector assets. So, regulated investment in equity market from the banking sector side is also another indicator of a strength of the banking sector in India. Similarly, regulated investment in other sensitive sector in the economy like the realty sector, the exchange, the foreign international dimension of the derivative segment sector, all these things sectors are sensitive to Indian economy. And so, all these sensitive sector investment are not allowed or regulated by the RBI, by the Reserve Bank of India, which is the strength of the Indian economy. Higher capital adequacy ratio, Indian banks having higher capital adequacy in the form of risk weighted asset ratio, that is capital of the Indian banks is quite high. So, any crisis in the Indian economy or a banking sector, the banks are overcapitalized and they can absorb the risks of the crisis. Similarly, least exposure to international market or international banking system. So, Indian banks are very limited exposure to international crisis, international market. So, international financial crisis may not affect significantly to Indian economy, Indian banking sector. Limited exposure to derivative and securitized segments. So, our derivative and securitized market is not so developed, and also banks are not allowed to invest beyond certain limit in derivative and securitized segment. This is also strength of the Indian economy. Then what are the weaknesses are there? The weaknesses are also there in Indian economy, Indian banking sector. Banks are not adequately capitalized despite 9 to 10%, 11% capital adequacy. This is not significant to bear any kind of significant crisis. The non-banking financial intermediary, that is the mutual fund, the investment bankers, the insurance sector, which are not properly regulated in India. So, non-banking financial intermediary sector, the NBFC are not properly regulated. This is one of the significant weaknesses of Indian financial system. There are multiple regulators and different segments of financial market, the RBI, the Government of India, the SEBI, Security Exchange Board of India, the NHB, then also what is called the insurance sector regulator. All these multiple regulators are there, and whenever there is a crisis, nobody owns the responsibility. So, regulatory conflict also there, you see the one of the significant weakness of Indian financial system. Lack of secondary market of many instruments, debt market, many other market, there is no secondary market. So, there is no such kind of window to live whenever there is a financial crisis for the depositors, for the investors side. The lack of secondary market for many instruments, one of the weaknesses of Indian financial system. So, the rating agencies are not there, corporate rating segments are not deeply rooted in Indian economy, and also availability of default premia not there in Indian economy. So, very difficult to price any kind of highly risky financial asset. This is also one of the weaknesses of the Indian financial system. There are lack of depth in the long term debt market. The Indian debt market and long term debt market provide capital to system. So, the long term debt market is not depth in India. So, this is one of the reason of financial sector crisis in Indian economy also, because there is no such kind of what is called capital availability, long term capital availability to absorb the risks. Similarly, fragmented payment system, there are many fragmented banking system, banking sector one payment system, realty sector another payment system, then what is called foreign exchange side another payment system. We have fragmented payment system. The fragmented payment system sometimes also contribute to financial sector instability. Unorganized cooperative banking sector, our banking sector, though commercial banks are there, they are regulated by the Reserve Bank of India. However, unorganized cooperative banks have multiple regulators, regulated by the State Cooperative Act, regulated by the Central Cooperative Act, banking by RBI also regulate. So, there are multiple regulators in unorganized banking sector, and this may also one of the weaknesses of the Indian financial system. So, at present what the state of the Indian financial system? If you see equity market at present is highly volatile, the high yield on the government papers indicate the interest rate has not declined, rupee is depreciating and highly volatile over the year, rising current account deficit government deficit increasing over the year, reducing FI inflow and FI inflow is some extent negative also. This has recently fueled the current account deficit. Export earning has been declining along with high corporate debt default, non-bank that is NPA of the commerce banks have been increasing. Food inflation has not reduced over the year. Negative growth in capital investment indicate business confidence is not there in Indian economy at present. All these things indicate what is called the state of the Indian economy at present, which is not so good, and we cannot say Indian economy at present is stable. So, stability need to be achieved through further deregulation, further deregulation of the Indian economy, giving confidence in the Indian economy, and also through the government efforts and collective efforts by the different sector of the economy to revive the Indian economy, and this required urgent measure at present to arrest the declining growth in the and increasing current account deficit at present. With this, let me complete with this session, and references for this is RBI Trend and Progress in Banks. So, that is published by the RBI. Similarly, RBI annual report, you can see various issues of RBI annual report. You can also see currency and finance published by RBI different years. These three references will give some kind of more reading material for you to understand the financial sector stability. Some questions I have framed for you. The model questions here, while defining financial stability, outline various theories of financial stability. You first need to define what is financial stability and what are the theories are there, the monetary approach, non-monetary approach, asymmetric information approach, and the asset liability approach. All these things you can discuss in this on financial stability side. Second question is outline various indicators of financial stability. We have discussed monetary sector indicator, real sector indicator, financial sector indicator. You can identify all these indicators of financial stability. And third question is describe the state of the Indian economy, Indian financial system as per the financial stability. First, on the basis of various indicators of financial stability, you first judge what is the present state of Indian financial system. Thank you.